Hey everyone, this is Mortgage Mario. So I want to show you an FHA loan illustration with 3.5% down. Don't forget to hit that like and subscribe button. So here's the purchase price, the loan amount, loan to value. It's a loan divided by the value of the property, the term. So it's a 30-year fix broken up to 360 payments, monthly payments, interest rate, and APR, which gives you an idea of what the real interest rate is over the entire loan term with the closing cost in mind. So essentially, the costs that come from the lender is Section A. So sometimes there can be an origination fee. There's discount points, which can buy down the rate. Those can be tax deductible. Underwriting fee. You'll have everything kind of below Section A or third-party fees on the transaction. So appraiser fee to find out the value of the property. Credit report fees. Upfront mortgage insurance premium, which is 1.75% of the loan amount. That gets financed into the loan amount because FHA is a very, very lenient forgiving product. That's kind of basically the ticket you have to pay in order to get very lenient terms when it comes to FHA loans. And remember, maybe if you have a higher credit score and a lower debt to income ratio, then your loan officer will go over terms with you and kind of explore your different options. And FHA might not be the best, but in certain scenarios, FHA might be more fiscally smart. So just depends on your situation. So you'll have attorney's fees. They'll kind of have their settlement cost. You'll have something called premium for lender's coverage. And that basically, in the event there's some type of faulty title, if the closing attorney or title misses something on title search, then essentially they will be covered. If there is a lien on the property they missed or something of that nature, then they won't have to be held accountable for paying that lien. Same thing, they have something called title owner's policy. That is optional. I typically, most circumstances, I recommend it because if you were to basically have title miss something and there was maybe a $30,000 lien on the property that the original owner actually owed someone money, then once you get title, then you would be held accountable for that. If you have owner's title policy, that would kick in like an insurance policy, and then you wouldn't have to pay anything. So this is kind of all the loan costs. A little misleading since about $6,000 is financed into the final loan amount. So really in that scenario, kind of the loan costs to get the loan. So when you ask kind of like, wait, what are closing costs? Well, that scenario, a really, fair, rough estimate, obviously, without having a subject property in mind or even knowing all the third parties that are going to be on the transaction, just for the sake of having ballpark numbers. You're going to be seeing around $5,000 or $6,000 probably for closing costs there. So pretty fair estimate there, pretty normal. And then you have kind of other costs, some government taxes. You have something called prepaid. So it's kind of an accounting equation to make the transaction work. So you'll always pay a year of upfront, a year of homeowners insurance premium. So essentially, like if you were to close in, let's say like September of 2023, well, then you'd be paid up for homeowners insurance on the property until September 2024 upfront. And that's just how it gets settled on a closing disclosure. So you have something called prepaid interest. That's going to be dependent on the closing date. So depending on what it says in the purchase and sale agreement, what day you close is going to determine that. But essentially, the way a mortgage functions is, say you close in the middle of August. Well, then your mortgage really won't begin until September 1st. And then you're always paying a month behind. So you always basically pay, in that scenario, your first mortgage payment, if you close in the middle of August, your first mortgage payment won't be till October 1st. That period of time from the middle of August to the beginning of September, your mortgage is kind of like in limbo. You're not actually really paying a mortgage on that. That prepaid interest will cover all that. And so that's just a daily interest paid until your mortgage actually kicks in. So a lot of people think when they see their first mortgage payment, they close in the middle of August, they see their first mortgage payment in October. They feel like they got off the hook for a month and a half on paying a mortgage. And believe me, you did not get off the hook for one day of interest. So you're going to have property taxes. So that's going to depend on the county and the city close in. Typically you have county, but if you are in kind of a more urban area, there could be city taxes. Sometimes they're incorporated. You'll see it on one bill. Sometimes it's not. That's just going to depend on the county and the city where you close. So again, lenders aren't the government, so they can't control the property taxes or the homeowners insurance. So next is escrows is probably one of the more confusing things with how this works, but to basically keep it simple, stupid, escrow is not really a cost. That's a savings account you're opening up with a loan servicer. So taxes, insurance are automated with the loan servicer. You don't actually have to pay your homeowner's insurance company or the government or the county or the city every year when that tax bill comes out. So typically they come out annually in the end of the year. So instead of having to worry about that and stress about running a check or remembering that, most people choose to escrow. And on FHA, it's actually mandatory to escrow. So that goes into a savings account to essentially pay taxes and insurance. We don't know when, if we're closing again in August and the tax bill isn't due until December, we don't know what that tax bill is going to be because it hasn't even come out yet. So they always want to basically create a cushion. We want you to open up the savings account to have a cushion. That's not a real cost. You get that money back either when you do a refinance, you actually get a check back from the loan servicer, or when you sell the property, then that actually you will get reimbursed for anything extra. And then every month, essentially the loan servicer will have you making an estimated 1/12 of what your annual homeowners insurance is or your property taxes. But let's say that, you get homestead exemption, your taxes go down. Well, they could actually be over collecting for your property taxes every month. And then you go look in your escrow account and you're actually being what's escrow surplus, or the opposite. Maybe they didn't analyze that right and you're underpaying your escrow once a month, which isn't good. Then you're in a short. And that's kind of why they want to have a savings there. That way there's no type of deficit when they actually have to make that payment where, hey, you got a house in Fulton County and the tax assessor says your annual taxes are $5,000. So they should have been collecting a lot more every month. So that's kind of the reason behind that. This can change just depending on your closing date in the county you close in. So as far as how many months they're going to collect up. So that's kind of just a very fair estimate there in a fictitious fashion. Yeah, so essentially that's just a breakdown of everything as far as the cost. I'll go over these numbers here. You have something called seller proration for taxes. So basically in this situation, let's say that the tax bill is due in December and you close in, the beginning of September. Well, the seller lived in the property for 9 months, essentially. So you're going to be paying the entire tax bill actually in December. So one role for the closing attorney, what they do is they'll actually do all the accounting on your final closing disclosure, which is when you'll sign at the closing table. And they'll go, well, that's not fair. The seller lived there for 9 months. And then the buyer is actually, once this bill comes out, is picking up the check for the entire year, even though they only lived there for 3 months. So you'll get actually reimbursed. So essentially in that scenario, they'll type in, and that, basically, well, they'll live there for 8 months technically. If you close in the beginning of September, that would be 8 months. So I'll just estimate 8 months. Then, in theory, what the closing attorney should go do is actually the seller is going to owe the buyer $2,333.33. So we can leave that blank for now. I always like to make that a pleasant surprise when you close, that if you get a little bit of credit back from the seller, you always want to be a little more conservative on the cash to close. You'll be more pleasantly surprised when you finally sign at the closing table and title balances the final closing disclosure and your cash closes lower versus, you get someone from Spaceship Logo Mortgage Company and they go in and lowball all these fees that are out of their control. And then your cash to close really is $5,000 higher at the closing table. You're going to be saying dirty four-letter words about that. And I choose to not conduct business in that fashion. So me personally, if I was conducting this for my family member, that's the way I would conduct it. You always want to be conservative when, there's just numbers that are out of our control. So that is essentially the total cash to close. That's what you would pay at the closing table for everything. So for the loan costs, for the down payment, remember the down part of this goes to equity. So the down payment goes to equity, then the other cost, and then again, some of that cost goes back into a savings account. So not all of that's like money that's just going to get totally just evaporate, is gone forever. And remember, building, appreciation over time. Houses usually appreciate, on average 5 to 6% a year, sometimes more, sometimes less. And then also part of your monthly payment is going to go towards principal. So buying a house is a long-term thing. It's not really a get rich quick scheme thing. It's basically you're cutting out rent, you're building wealth and equity, and you have, you're on a fixed payment. So at least your payment's never gonna go up. And then also people are freaking out about interest rates. And it's basically one of those things, no one can see the future on interest rates. If they go up, well, then that's awesome. You got a rate that's lower than what would have been in the future when you bought a house. If they go down, you can always refinance your mortgage and get a lower interest rate. If they stay the same, well, then assuming you're renting, you cut out, months worth of rent, years worth of rent, depending on how long you live in there at that point. And then also you build equity. So mathematically, phenomenal wealth building tool. Obviously, when it's more from a long-term perspective, I usually just say, hey, it just depends on what the market's doing, depends on your financial situation. But a good rule of thumb is if you're going to live there for 5 years, typically it's a very good investment, a very good wealth building strategy. So I hope this helps. If you ever have any questions, you can always visit my website, mortgagemario.com. Have a wonderful day.